Hello. Thank you for taking time out of your busy schedule to attend today's webinar. My name is Andrew Schwartz. I'm partnered with my brother Rick Schwartz in the CPA firm of Schwartz & Schwartz based in Woburn, Massachusetts. Each winter, we prepare just over 2,000 personal tax returns. About 90% of those are for physicians, dentists, and psychologists. The rest of the year, April 16th through January 31st, we work with about 300 one and two owner medical and dental practices. About 250 of those are dental practices in a variety of specialties. So we're very familiar with the issues affecting you and your colleagues. So let's get right into it and let's talk about what's involved with doing your financial due diligence. So I know that there's some people, some buyers who attended the webinar today. And so this will be helpful to them as they figure out what to look for when they find the perfect practice. And I also know that there are some sellers at the webinar today, and here's some things that the buyers are going to look at when they find your practice, your great practice. So it'll be good to know, and it'll be some things that you can work on now in anticipation of selling your practice in a couple of years. So one second. So let's start with the way I look at it is when you're buying a practice, there is a practice valuation, and that's just like a home appraisal that sets the value for the practice. And if you purchase a home, you also will have a home inspection. And the due diligence process is just like the home inspection. So here's a very funny little comic. It says the couple is looking at the home inspector, and the home inspector says there are no skeletons in the closets, but you might have trouble with those in the backyard. Haha. Okay, so let's get right into it. And for starters, let's just talk about some valuation basics. So the first basic is the definition of what fair market value is. And if you look it up online, what you will see is that fair market value is the price a willing buyer would pay a willing seller for an asset, provided that the seller is under no pressure to sell and the buyer is under no pressure to buy, right? So that makes a lot of sense. What's the most you're willing to pay? What's the least that the seller is willing to take? And that's kind of where it ends up in many cases. But in the dental world, or like with most businesses, especially service businesses, the real value is this concept known as excess earnings. Now, excess earnings is the opportunity to earn more by owning a practice than you can earn by working as an associate, right? So anybody who owns a practice, you know that there's a lot of risks and headaches and just a lot more involved, a lot more time involved with owning a practice than when you just work as at a practice as an associate. So in exchange for the additional risk, headaches, and work that you need to do by owning a practice, you should be compensated for that by earning more money by being an owner of a practice than you're going to earn by being an associate. Okay, so when you're looking to buy a practice, believe it or not, that's what you need to quantify. It's the excess you can earn by being an owner that outweigh the risks and the headaches you're going to deal with by being an owner. Okay, but there's also basic economics at force here. So a lot of people who went through college and dental school and all that stuff never really took any accounting classes, never really took an economics class. And now economics, to be honest, is very, very interesting. And if you have the chance to do some reading or maybe even take a college level class in economics, I guarantee you're going to find it interesting. It's actually not very, very difficult, especially the beginning concept. So the first concept that we learn is this concept of supply and demand, right? So all the markets are at equilibrium. There's a certain number of people who produce products or a certain number of service providers who provide a service. There's a certain number of people who need those products or services. And the price is set based on how many people want it, which is demand, and how many companies supply it, which is supply. So in any market, supply and demand is at play, and that includes the purchase and sale of dental practices. That's a market that has a limited supply and a certain amount of demand. So Now we've seen in certain instances how supply and demand work together, and you've noticed it but don't realize it's supply and demand. So the first is around Valentine's Day. What happens to the cost of price? What happens to the price of roses and other flowers around Valentine's Day? Well, the supply is pretty fixed. Demand increases exponentially, so that forces the price of roses to increase. What about the automobile industry? What happens to the auto industry in times when the economy isn't doing that great, when a lot of people aren't buying cars? Well, once again, supply is pretty fixed. The auto manufacturers more or less produce a set number of cars every year. So when demand goes down, prices need to go down. And you see that where car manufacturers will offer larger rebates or bigger discounts to purchase a car. So how does this work with dentistry? Well, in dentistry, for the purchase and sale of dental practices, the supply of the dental practices is relatively fixed. There's more or less 4,000 different dental practices, including specialty practices, in Massachusetts. So assuming that number is correct or close to correct, and the average dentist owns their practice on average for 20 years, that means about 200 practices are put up for sale or put up for transition every year. Right, 4,000 practices, average term to own the practice 20 years. That means that there's about 200 or so practices put on the market every year. Now demand is high. Demand is all the people graduating from the dental schools, and now it's corporate dentistry is in there pushing up demand, right? So it's people who aren't even from the area now want to buy practices here. So what I've seen in my 25 years of working with dentists and dentists looking to buy practices and all that, demand has seemed to be increasing year over year. There seems to be more demand now than ever before, and the supply is relatively fixed. So as we said in the last slide, when demand is high and supply is fixed, what does that cause prices to do? And that causes prices to increase. And that's exactly what we've seen in this whole dental market. Okay, now there's another force at play here, and that's the OPM basics, other people's money. Now this came out actually around the time I was in college. So I graduated from college in 1987. That was when Wall Street really was doing great, and everybody was using other people's money to make money. So they were trying to find deals, and instead of putting their own money in there, which is a limiting variable, they would try to get other people to invest in their projects, and they would make money off other people's money. Well, believe it or not, dentistry uses that same type principle, because when most people buy a practice, they borrow 100% of the purchase price of a practice, plus they get some working capital. So most young dentists buying practices aren't asked to put any of their own money into the deal. Instead, the money comes from Bank of America, TD Bank, and some of the other dental practice lenders in the area, who makes it very easy for dentists to purchase dental practices. But when that's the situation, and the buyer is using other people's money, they only have access to so much of that other people's money. And in this day and age, the lenders, Bank of America, TD, some of the other ones, they're lending more or less up to 85% of the collections of a practice. Now, some of the really profitable practices, they are even going a little bit higher. We've seen deals where the lenders have lent 100% of the annual collections of a practice in connection with the sale of a practice. But for the most part, it's kind of topped off at 85%. And if the buyer doesn't have any more money to put into the deal, then the amount that the practice will sell for, the value of the practice, or the maximum that it'll sell for, is what the lenders are willing to lend. And that's what puts the limit at 85% of collections. So as a matter of fact, what we're seeing these days is most practices, good practices in the Boston area, in a desirable area to live, to work, live and work, is about 85% of collection, sometimes going up a little bit higher. But the banks also look at the net income of the practice, and we're going to go over that. But they'll only lend a certain amount based on net income. So the rule of thumb is about 85% of collections maybe drifting upwards towards 100% for the better, more profitable practices, or 2 times net income. That's the rule of thumb. And just to add a little bit of perspective, these days, to open a practice from scratch, you're looking at spending between $300,000 and $500,000 if you find a space. Even if you're going to lease a space to build it out and to purchase the equipment, you're looking to spend between $300,000 and $500,000, and you would have no patience to open from scratch. If you find a practice that's collecting $500,000 or less, more times than not, you end up with a turnkey operation. You end up with a practice with patients that will cost you the same or less than opening from scratch in many situations. And as I said, and you'll have plenty of patience. So yes, the practice will be older. The practice will probably be a little bit dated. The equipment's not all going to be state of the art, but you will get a running operational practice for the same price that it would cost you many times to open from scratch if you find one of these great practices where the seller is only collecting $300,000, $400,000, $500,000 a year. Okay, great. So the question that you want to ask yourself if you're a buyer is, are you ready to own a practice? So here's another very funny comic. And this poor dentist is sitting behind a desk, and he comments to the front desk person, paper cuts are becoming an occupational hazard. So once you own a practice, as I said before, the good old days of going to work, treating patients, and going home without a care in the world, those days are over. All of a sudden, you're going to spend a portion of your day managing people, paperwork, dealing with insurances, dealing with patients who didn't get the perfect experience. There's a whole list of things that you're going to need to deal with. And you really do need to ask yourself if you're ready to own a practice. I've had not too many, but a few clients who purchased practices, and within a year or two, the practice was up for sale. They hated owning a practice. They hated every part of owning a practice. And they just wanted to go back to working as an associate, and that's what they did. Within a year, they were done. They didn't want to own. But most of our clients who own practices, they deal with the management issues. They deal with all the issues of owning. They appreciate the opportunity to be compensated a little bit better by owning, and they like doing things how they want to do things. So ownership, for most people, works out great. All right. So when we look at a practice, when we help somebody determine whether the practice is a worthwhile opportunity, the first thing we look at is the practice collections over the 3 years and the adjusted net income for the 3 years. So if you're doing your due diligence and the broker or the seller gives you their tax returns, that shows the taxable income being reported to the government. That doesn't show what the true adjusted net income is that you would earn if you were to own the practice, assuming everything stayed the same. And we're going to go over how that's calculated now. But we're also going to discuss the importance of collections, because that's what you're really buying. You're buying the opportunity to treat the patients, bill the insurance company or the patients for the work that you do, get paid, and earn a living. So let's see. All right, so this is a due diligence report we did a couple years ago. And the first step is we just take all the information right from the seller's tax return. So this is the information that was reported to the government. It's the collections, it's the dental supply and lab fees, it's all these other expenses. So, excuse me, so this is as I said, taken right from the tax return, and this is the information reported to the government. But these numbers here, especially if the practice is a corporation, this one wasn't, but if the practice was a corporation, the net income per the tax returns has nothing to do with the net income that you would earn if you were to own the practice. So let's see. So the first step that we do when we're doing the due diligence, or the brokers do when they're valuing a practice, is they'll take the numbers from the tax return, and then they'll add back all the expenses reported on the tax return that are more personal in nature. We're trying to figure out what the buyer would earn from this practice, assuming everything stayed the same, if the practice were to only pay real overhead expenses. None of the personal type expenses would be included. So you can see the list right here, but in our calculations, when we do this, we include the cost of the associates to remain. So this is actually one of the toughest things. So when you're trying to figure out how much you're going to earn from the practice, you don't care so much what the seller paid for the associates that the seller employed at the practice. You only want to include the associates that are going to remain. And if when you take over the practice, there won't be any associates, then you would put 0 there. We also add back automobile expenses because while automobile expenses are deductible for most business owners who run their expenses through the car, their car expenses through the practice, that's not overhead. Advertising, most practices spend just 1.5% of their collections on advertising. So if it's one of these practices that spends a lot of money, we would make an adjustment for that. Some doctors like going to a lot of conventions, we add that back. Some people use dental supplies to kind of hide some expenses that maybe don't really belong in the practice's books. So we adjust that to 6.1%, that's kind of specific. We adjust it to 6-7% of collections. We add back depreciation and amortization. Investing in the practice is important, but that's not overhead. Collections adjustment, maybe they're not charging for exams, and we would pick that up. Maybe they're charging for things that procedures that you wouldn't be able to do, so we would back that out. Interest expense isn't overhead. It's a deduction, and you need to pay it if you have a loan, but that's not overhead. Meals and entertainment, that's not really overhead. It's something people deduct on the practice. Same with travel. Any owner, life insurance, disability insurance gets added back. On a corporation, we would add back the owner salary, but we'd also factor in if the owner's staying on, what the salary would be. Sometimes the professional fees are very high. We would add something back for that. Repairs and maintenance is another one of those places where people sometimes bury some things that don't belong. Owner retirement plan contributions, and sometimes the owner would have a family member on the books that isn't really working at the practice. So we make all these adjustments, and we come out with what the adjusted net income would be. Now, for this one that we did, as I said, this is a schedule. So this is a sole proprietor. So the adjustments usually aren't as great as when we make the adjustments from an S corporation to adjusted net income that the buyer would earn. But we did need to adjust for rent. This practice, because it was sole proprietor, they weren't paying any rent to themselves, so we had to pick up the rent. There was we had to add back. There was a family member on payroll. We added that back, and then we added back depreciation. So the key takeaway here is adjusted net income. So if the person were to buy this practice and everything were to stay the same, this is how much money that they would make each year. They would make $450,000 or $430,000 or $442,000. We love to see when these numbers are consistent, because when the adjusted net income per owner is consistent, it's more, you have a better chance of continuing at the same rate. When these numbers fluctuate, it adds more uncertainty to the whole calculation. Okay. Okay, so then we go and we try to put these numbers into context. So here, every year we collect a lot of data from our practice clients, and we use that data to help our practice clients understand what's going on with their practice, but we also use that data to help people buying a practice to put their information in context. So in this case, this graph, we don't explain what these things are. The x-axis is collections, and the y-axis is profitability. It's very, the correlation is very high. These numbers really hug the trend line. So and most of our practices seem to be able to collect $700,000, $800,000, $900,000 of income. A practice that gets to over $1 million of collections, that those practices are starting to separate themselves, and a practice with one owner that gets to more than $1.5 million of collections is really starting to separate themselves from the pack. Well, this practice, the collections and the profit together put this practice actually a decent amount above the trend line. So this practice is more profitable than other practices of a similar collection size. So that's good. If you find a practice that's below the trend line here, you really have to figure out why it's below the trend line, because you want to buy practices that are more profitable than the peer group, not less profitable. Okay, so I mentioned this a few minutes ago, but what you're buying when you're looking at a practice, there is equipment and there's a build out and all this stuff. but what you're really buying is you are paying for the opportunity to treat the current patient base and collect fees based on the procedures provided to those patients. That's it. You're buying the patients, the opportunity to work on those patients, and to get paid based on the work that you did. It's as simple as that, and we're going to go over what to look at to really get a good sense of the practice production and whether it's a worthwhile opportunity for you as the buyer. And as I said, if you're a seller, here's an opportunity to look at things that you might be able to tweak the next couple of years to make your practice more desirable to potential buyers. All right, so when we do one of these reports, we focus most of the report on revenue. We are going to talk about overhead a little bit later, but revenue is the most important part of it. So in the report, and if we were at Yankee, if it was a live class, you would have an example of one of our reports in front of you. So here, this practice collected $868 one year, $870 the next year, and $937 the year after that. So the collections were very consistent. We looked at the profitability, the adjusted profitability was very consistent, and consistency allows you to be more confident in the practice that you're buying. All right, so when we collect all this data from our different clients, one of the things we do is we use the data to prepare these 11 productivity metrics. We actually do 12, and I'm going to show you the 12th and most important one in a couple seconds. But some of the data we look at is on this table. When we do this for a client or for someone with a due diligence report, the first column is the metrics we calculate from the practice, and the second and third column are the metrics, the median and mean for practices that collect less than $1 million per year, and the last two columns are from practices that collect more than $1 million per year. And as I said, most of our practices have there's just one owner. We deal mostly with one owner practices. So we look at collections per doctor hour, and you see the big difference between what the smaller practices collect per doctor hour and the $1 million practices. We look at number of active patients. We look at collections per patients, collections per procedure, procedures per patient. So that's all the procedures you do. And then we back out the diagnostic and preventive procedures per patient, and we look at the dentistry being done per patient per year. We look at Perio, which we'll talk about, the Perio percent. We look at recare, which is the percentage of patients who came in at least once during the year, who came in twice for 2 cleanings. Number of new patients, which if you're buying a practice is very important. We'll discuss that. And we look at adjustments, discounts, and write-offs, and that's mainly the difference between somebody's standard fees and the reimbursements at the insurance companies. Okay, so these are great metrics. When we meet with a client, after we do these our benchmarking report, it always leads to a very interesting discussion, and it really is quite telling about what's going on with the practice production. All right, but here's the important part of the presentation. This helps you figure out what it is you're buying. Remember, because you're buying the potential to produce revenue. So the prime number, the most important number to look at, and the number when you look at a valuation report prepared by many of the brokers around here, a number that is usually incorrect. The most important number is the number of unique patients treated. Now, when we look at this, when we do our analysis, we base this on number of unique patients who came in for at least one visit during the calendar year. So we look at it over 12 months. I know some people say an active patient is someone who came in the last 18 months, some say 24 months. For the purpose of our discussion, we use a patient who came in at least one time during a 12-month period of time. So let's take a look at this graph, and this shows how important the number is, the number of active patients. So this data here, this is from the report that we just finished up for 2019. And if you look, you can see that the correlation in 2019 between the x-axis is the number of unique patients who came in at least one time during the year to the practice, and the y-axis is collections. So the correlation from the data we collected last year was almost 90%. So the number of unique patients who came in for at least one visit during the year for our practices that we had data for is an 88% predictor of revenue. So for starters, that's why if you're going to have one number right when you're doing your due diligence, you want it to be that number. You want it to be the number of unique patients who came in during the year because it's such a predictor of revenue. So I do want to point out, if you look at this trend line that we put through the data, the trend line is not at a 45-degree angle. So it doesn't basically say, this graph doesn't say that for each additional patient that comes in, you're going to get the same marginal increase in collections. Based on doing this over the years, we kind of came to the conclusion that a full panel of patients for a full-time, a 4-day-a-week dentist, a full panel of patients for one 4-day-a-week dentist is about 1,200 to 1,300 patients. Okay, once one dentist working 4 days a week has a panel of more than 1,300 patients or so, the amount of dentistry being done per patient goes down. There's only so many hours in the day, and the dentist can only get to so many patients per day, so it's just a function of not enough capacity. So that's why you'll see that that the trend line is flatter than 45 degrees. So when you're looking at a practice, and the practice shows that it has like 1,200 or 1,300 patients, and you're going to work there alone, you're buying a practice that has a full panel. If you're looking at a practice that has 2,000 patients, you're not going to be able to get to all the work. You just can't. It's just too many patients. And if you look at a practice that has like 800 patients, you know it has about 2/3 of a panel of patients. Okay, so so if you're looking at a practice, if we're helping you with the due diligence, we would put on the graph in a red square or different, it's usually red square, whether the practice is above the trend line or below the trend line. Now, what do you think's better? If you're looking to buy a practice, do you want to buy a practice where the seller is below the trend line in terms of patients, in terms of money collected based on patients treated, or do you want to be above the trend line? Or do you want the practice to be above the trend line? Did I ask that question right? I think so. Okay, so the answer is, if you can find a practice that's below the trend line, that's a great practice. That means the patients are coming in and the dentist is not doing as much dentistry, it's not collecting the same amount of money per patient as our average dentist would collect by treating that many patients, all right? So if you look at a practice that's way above the trend line, if you're the seller, that's great. You really produced from your patient base. But if you're the buyer, that may not be that great, because how are you going to be able to produce at the same rate as the seller, unless you're as productive as the seller and you're as capable as at presenting treatment plans and having that accepted. So if this practice were for sale and we were helping somebody with the due diligence, I would let our client know that I'd be a little bit nervous for them buying the practice. It would be very difficult for whoever buys this practice to keep the production at this current rate, but maybe they could. Okay, so determining the number of patients treated can be very challenging. Eaglesoft makes it easy. If you print out a patient analysis report, right on the top right, it says patients treated during the last 12 months. Dentrix makes it hard. Dentrix, you have to use the mail merge function, and we send instructions to our clients, but a lot of them still have trouble getting this to come out right. We actually started referring a lot of this type work to Tabitha Lugo. She's now a dental practice consultant. She was a Dentrix trainer for a number of years. She can get any information out of that program that you would want to look for. And she also helps clients buying a practice who need help with the due diligence. She'll spend some time with you, either remotely or whatnot, and help you gather the information. And Open Dental actually is $100 per month. Competitive to Eaglesoft and Dentrix. People who have it love it. It's very easy to get this information from the number of patients treated during a year. They have a canned report for that. All right, if you're wondering, this is this year's 2019 numbers. Practices that collected less than $1 million collected just over $600 per patient. Practices that collected more than $1 million, they just do a better job, getting the patients in more often, doing more work when they're there. They collected $850 per patient on average last year. Okay, the second indicator we look at is the productivity barometer. And what we do is we take a look at the production from the diagnostic and preventive codes, and we compare that with all the other production from the office, which we call dentistry. And the average practice that we work with, actually the goal for most practices is to produce $2 of dentistry for every $1 of, diagnostic and preventive procedures, right? So 2-to-1 ratio. Anybody looking for a home office in Whitman? We have this great home office opportunity. This guy is kind of checked out a little bit. Very strong hygiene. He's doing 40 cents of dentistry for every $1 of hygiene. He's also doing the hygiene, but he's doing 40 cents for every $1. Most practices try to do $2 of dentistry for every $1 of hygiene. This practice that we looked at, the production, this isn't collections, but the production was $1.2 million. Hygiene production was $516,000, so the dentistry was $685,000. So instead of doing $1 million of dentistry on the $500,000 of hygiene, this guy, this seller, I don't know if it's the guy who won, this seller did $1.32 of hygiene, of dentistry for every $1 of hygiene. So right there, this shows is a good opportunity. Potentially, there's $300,000 more production that a dentist could be doing if they're just more productive than the seller. Another thing to look at for the barometer is how many hygiene days there are per year. So the rule of thumb is there should be 1 hygiene day. So a hygiene day is a hygienist working 8 hours, right? So if a hygienist works 4 days a week, the hygienist works 4 hygiene days. Hygienist works 2 4-hour shifts during the week. That hygienist is working 1 hygiene day. So the rule of thumb is 1 hygiene day for every 200 active patients. I learned this a couple of years ago at Yankee, and it actually holds true. I've asked a lot of my clients about it, and anecdotally, if somebody has more than 1 hygienist for every 200 patients, there's holes in the schedule. Less than 1 hygienist for every 200 patients, they're booking months out. They can't even get a new patient in the door. So the average rule of thumb is 1 hygiene day for every 200 patients. And this practice had 9 hygiene days, and 9 hygiene days, 1,700 patients, so it's right in line. But this is something else to look at. And as I said, this number usually holds true, and it just kind of confirms what we think we're looking for, what we know we're looking for, which is good. Okay, so this is a very important barometer, dentistry to hygiene. Okay, then we want to look at patient engagement. So patient engagement, we look at recare percentage, the percentage of patients who come in twice during the year for cleanings and whatnot. And then Perio percent is the percentage of the patients coming in for SRPs versus standard cleanings. Okay, so recare is, you basically look at the number of code, the number of procedures under 120, 150, and 180. Or if they don't charge for all the exams, you use the cleaning codes, the 1110s and 1120s. You divide it by the active patients and you divide that by 2. That's why it's so important to have the right number of active patients, because this recare percentage is a very important number. And if the broker gave you some crazy number of active patients, then this thing won't be meaningful, and this needs to be meaningful. Recare percentage based on our 2019 study, about 70% of the patients at the smaller practices on average came in for cleanings, and just over 70% came in for 2 cleanings during the year. For $1 million practices. All right, so, but we see practices with very strong hygiene where this number, where the recare percentage is 80%, 85%. The stronger the hygiene, the more desirable the practice. The hygiene, as you know, is the engine to most practices. Okay, we also look at Perio, and Perio is a important indicator for patient engagement. Perio, again, is the SRPs and the Perio maintenance. So the rule of thumb for most practices, according to the practice consultants out there, is hygiene makes up 1/3 of practice production, right? $2 of dentistry for every $1 of hygiene. And then the Perio codes make up 1/3 of the hygiene production. Okay, and so so why does Perio, why does it correlate so high with patient engagement? Well, it's a more engaged patient base because patients, they're more willing to accept your treatment plans. They come in more often during the year to your office, and they are willing to spend more money on dentistry than somebody who just has 2 cleanings during the year. Okay, so the way I was taught to to calculate Perio percent is you get the number of cleanings, the 1110s. You also get the number of the SRPs, the 4341, 4342, and you also get the number of Perio procedures, the code 4910. And the numerator is the 3 Perio codes, and the denominator is the 4 codes, right? So there's probably other ways to do it, but one of the Perio consultants said this is the way that she does it, and so this is the way we just started doing it. But it's a very important number, and for the average smaller practice, the Perio is about 11, 12, 13% of the procedure. So the Perio codes divided by the Perio codes and the number of cleanings is 13%, where the $1 million practices, they just do more things right, and they're closer to 20% when we're looking at that one number. So we see practices where there are 0 codes, 0 procedures put to any of the Perio codes, and it's hard to believe that they're not doing any Perio. So they're either referring everything out to a periodontist, or they are doing the work and not billing it accordingly and getting compensated accordingly. And we see practices where the hygiene is strong and the Perio is like 35, 40% this percentage, and that's just a stronger indication of a more engaged patient base. All right, so we have strong patient engagement, which you can figure out by looking at the recare percentage of patients who come in for 2 cleanings during the year, and the Perio. And the other number we want to look at is how much dentistry is being done per year. So if you happen upon one of these practices that has very strong hygiene, patient base that is accepting the Perio, which indicates that they're willing to accept dentistry, but not much dentistry going on, you have yourself the winning combination. Okay, number of procedures with Dentrix and Easy Dental, you get it from under management reports. The report's called the Practice Analysis Report. On EagleSoft, you get it from services, the service side productivity general. EagleSoft, this report you can actually only do real time, and whenever you do it, it's year to date. Once you close a month or close the year, you can't generate the report again. There's no way to do a date range as far as I know. But they have this place where they keep all these old reports that you've generated in the past called Smart Docs, and you can find these reports in your Smart Docs if you're an EagleSoft user. All right, so let's take a look at this. The average smaller practice. The average smallest practice, they perform on average about 6 procedures per patient per year. Now, if you figure that 70% of the patients come in for 2 cleanings, 2 exams, and a set of X-rays, that's a bunch of the procedures right there, and the rest is just the dentistry. So the smaller practices, the patients come in for 6 procedures per year. The $1 million practices come in closer to 6.5 procedures per year. But when we back out the preventive and the diagnostic codes, this takes a look at how much real dentistry is being done, okay? So this is the number of non-preventive and non-diagnostic procedures per patient per year, and with the patient being someone who came in for at least 1 visit during the year. In the average smaller practice, they perform about 1.5 procedures per patient per year when you back out the hygiene being done, the diagnostic and preventive codes. And the $1 million practices, they're closer to 2 procedures of dentistry per year. All righty, so here we go. So it's we're 40 minutes into the presentation. We talked about the prime number is the number of unique patients who came in during the year. We talked about the barometer, which is the dentistry production to hygiene production. Well, here's the winning combination. If you find a practice like this, and you end up overpaying by $20,000 or $30,000, you're not overpaying. You are buying a great practice, most likely, a practice that you can that has a lot of potential, that you can grow, and you can make it a great practice on your own. And that is a practice that is performing more than 6 procedures per patient per year, where the non-diagnostic and non-preventive procedures per patient for the year is close to 1. And those are out there. There's actually pretty common where the seller isn't doing all that much dentistry. And then you also want a practice that has strong recare and better yet, strong Perio too. So 6 procedures per year in total, close to 1 procedure per year for the non-preventive, non-diagnostic procedures, and strong recare. If you're a seller and you have a practice like this, there shouldn't be a buyer that comes to look at the practice that says no. All right, what happens if you find a practice that has high collections per patient? It's actually, as I said on a slide a little bit earlier, that's something to be nervous about. You need to figure out whether you can be as productive as the seller, or maybe the seller just did a lot of work and they were very aggressive about doing work to the point where it may be a little while before there's much work to do on the patient base that you're buying. And you also have to be a little bit concerned about fee-for-service practice. So fee-for-service practices, if you own one, that's great. That means you get paid your full standard fee for the work that you're doing. But if you're looking to buy a practice and you come across a fee-for-service practice, you actually have to be careful, because during the transition, there's a better chance that those patients aren't going to come back. Anybody who drives any distance to come to the office and they're paying full price, they're probably going to go to somebody closer to where they live. They drive the distance because they trust the seller. Unless you've been working at the office for a couple of years and had the opportunity to build up the trust, it's not very likely that they're all going to travel a distance to see you. Also, if they have insurance, they may switch to a provider that takes their insurances. They like the seller, they don't know you. If they're going to somebody new, they might as well go to someone who takes their services. I mean, their insurances. So if you're in the position and you find one of these practices, don't jump for joy. It's actually a more challenging transition. If you can get through the transition, you got yourself a great practice. And there's things you can do to make the transition something that you'll survive, and the patients will keep coming in. But you have to be a little careful about that. All right, number of new patients, very, very important. Smaller practices on average brought in about 12 a month. The $1 million practices brought in about 25 or 30 patients per month. Most of the patients that come into a practice are referred by other patients, so it's a matter of the seller training their patients to make referrals and training their staff to listen to cues and to make sure if a referral comes in that they are brought into the practice. What we've seen over the years is that the number of new patients that the buyer will bring in after the transition will be equivalent to what the seller was bringing in at the time they sold the practice. And if a seller has a full panel, they're not encouraging their current patient base to refer business to the practice. So it's very tough. It can be done, but it takes a long time to retrain the patient base to start making referrals. So it's just something to look at. And don't forget, the number of unique patients treated in a year is the most important number. So one way to keep that number high is to have new patients continually coming into the practice. Other reports. This is a report, the Unscheduled Treatment Plan report. I'm an accountant. I'm not a dentist. Like I just know what my clients and other people I in the industry have told me over the years. But I guess any time that a dentist presents a treatment plan, it gets into the Unscheduled Treatment Plan report unless it's scheduled. And unless those are manually removed or a box is clicked off every once in a while, it just becomes this big pile of unscheduled treatment plans. That's not very meaningful. However, all the programs have a canned version of this program, of this report. So you might as well ask for the Unscheduled Treatment Plan report and just see if you can make any sense of it. And hopefully you'll see that there's a lot of work that needs to get done. You also want to look at the AR aging. This is also something that the seller has developed habits with the patients, and this habit is how quickly they pay their bill. So you want to look at how much old stuff is on the aging. If there's a lot of old receivables, then the seller, has let things slide, and you're going to have to retrain your patient to pay at the time of the service. But if you're buying a practice, you actually want to go through the AR aging and look real carefully for credits. Credits are money that the practice owes back to the patient. Maybe the patient paid an estimated amount for the procedure, and then the insurance company paid more than the practice was expecting. So that money has to be paid back to the buyer, either by writing them a check or by offsetting future work that's going to be done. So definitely ask for an AR aging report and definitely take a look at all the credits. I think even the software do you can get a report just on the outstanding credits, but it's in some practices this is real money. You have to be very careful. Okay, so I spent a lot of time on the production, the practice productivity, because that is the most important part of the whole analysis. That's what you're buying. Practice overhead. Ultimately, you as the buyer will adjust the overhead as you see fit. You'll hire the staff, the size staff that you want to work with. You'll use the labs you want, the supplies. You'll be extravagant or you'll be frugal with supplies. Rent is tough to change. The rent that you're paying for the office, or if you bought the office, the mortgage you're paying for the office. That's the toughest cost to adjust. But otherwise, all the other overhead expenses, you have a lot of control over determining what that is. And this is interesting. Probably none of you took accounting classes, but if you did, we learn about variable overhead versus fixed overhead. Variable overhead fluctuates with collections, and that's your dental supplies, your lab, right? The more work you do, the more supplies you need, the more high-end dentistry you're providing, the more lab fees you're going to be paying. Where fixed overhead doesn't fluctuate, the staff for most part is fixed. Yes, you can hire and let people go, but for the most part, the staff you have, you're going to pay the same staff wages every month. Rent is fixed. Excuse me. Your IT, your insurances, your professional fees, all that stuff is fixed and doesn't fluctuate. So you have to pay that every month. But let's take a look at the average overhead for practice. But before we do that, as part of the data that we collect every year, we also graph practice collections with the overhead. Okay, so here's what the practice collected. Here's the practice overhead. The correlation for all these practices, look at how close these data points hug the trend line. It's 95%. So when I say overhead doesn't matter, overhead, it does matter because it determines how much money you're going to make. But for the most part, every practice, one way or the other, spends a similar amount of money on overhead than other practices. And this is non-doctor overhead. So it doesn't include any of your salary or benefits or other money you put to the practice. And it doesn't include what you pay your associates. This is the non-doctor overhead. And it hugs the trend line. But if we take a look at it, the better run practices are the more frugal owner. The overhead is about 45%. And the people who can't control their spending quite as much, they spend closer to 60% on overhead. And the biggest expense is staff expenses, 22% of the collections. This is a percentage of collections. 22% goes to staff expenses for the more frugal, the leaner practices, where 27 or even 30% can go to staff expenses. For the higher practices, facility runs between 5 and 7%. Same with supplies and labs, lab fees 5 to 7%. Advertising promotion, most of our clients spend 1 to 2% on advertising. There really isn't. It's hard to spend money to bring patients in. There's smart ways to spend money, but the best way to bring in patients is by your patients having a good experience at your practice and referring other patients to you. But you do need a website, and some people do some web advertising, and you want to get good reviews and stuff like that. And everything else is 7 to 10% of collection. So well-run, very lean practices, they can keep their overhead to the mid-40s. Other practices that can't quite control their wallet quite as much, they end up spending 60% on their collections on overhead. But for the most part, 95% of overhead is predictable by your collections. So it's important to understand your overhead. We help our clients understand it, but it's not a deal breaker when buying a practice. Okay, so high overhead, it may not be a deal breaker. You might have capacity to fill. Maybe your fees, your standard fees are low, or the fees of the practice are low. We see it where overhead's high and the seller's not collecting for exams. Maybe they're not doing a good job collecting their receivables, and maybe they're just a hygiene factory and they're not doing much of the higher end procedures. Maybe they're referring out a lot of the procedures that other people keep in-house. Okay, we look at the standard fee schedules. It's only so meaningful if it's mostly an insurance-based practice. The fees you charge aren't really all that relevant. You get paid what all the other dentists in the area get paid for providing those services for the most part. All right, few more slides to go through. The first is a very important slide that we have, a very important bit of information we have at the end of the report is how much money you would make if you were to own the practice and you had a loan for the practice. So when you work for somebody and you get a W-2, it's easy. They pay you, they withhold taxes, and the net amount goes into your bank account. When you own a practice, you generate the profit from the practice, then you need to pay your loan, and then you pay taxes out of the profit you generate, less depreciation and a few other things. So, so this estimated tax that you pay is a function of this number, even though you have to pay the loan. Okay, so even though this practice made $440,000, after paying the loan and after paying the taxes on the $440,000, this person who bought the practice, if everything stayed the same, would put $210,000 a year into his or her bank account. After 10 years, when the loan's paid off, all of a sudden $300,000 would go in. The taxes go up by a little bit, and no loan payment, so the amount of money going into the bank account. This isn't your gross pay. This is the amount of money you're earning after you pay your taxes. We calculate here, so it's an important, very important calculation. All right, if you find a practice that you like, the first thing you do, you need to submit a letter of intent. Usually the broker will give it to you, and you set the price. Once it's accepted, you have 2 to 3 weeks to go into the office and do your due diligence. When we help somebody with the financial due diligence, we give them 18 steps that they need to go through when they're at the office. During this time, your lawyer and the seller's lawyer are working on a purchase and sale. This is the most important document. When the purchase and sale is signed, you have a high level of confidence that the deal is going to go through. Once the P&S is signed, that's when you want to set up the entity, because things can fall apart before the P&S is signed. But once you're sure that the P&S is going to be signed, you set up your professional corporation, you set up your LLC, you set up your entity. You need to get a new employer identification number, and that takes just a few minutes. And you need to get a new NPI number for your practice, even though you may have one personally. And once you have the name of the practice, the EIN, and the NPI number, you want to start getting credentialed. It takes 4 to 6 weeks to get credentialed. And in theory, you can't bill insurance companies until you're credentialed. Some people do it under the seller's information, but you really don't want to do that if you can help it. And when that's all set, you close on the practice and the real estate if you're buying the real estate too, and you are a practice owner. Real estate, if you're buying real estate, you definitely need to review the lease. A lease can be a deal killer. If you don't have a lease in place to for probably like 5 years or more, including options, the buyer is not going to be able to get financing. A lease, there needs to be a lease that the buyer can stay in the space. If not, no bank is going to lend on that. If the seller owns the real estate, maybe you'll get a purchase option, which means at some point down the road, you can tell the seller that you want to buy the real estate. A right of first refusal is not quite as good as a purchase option. A right of first refusal means if the seller is looking to sell the real estate and gets an offer, they have to bring the offer to you and you can match it. And if you do have a real estate, you do want to set up an LLC to hold the real estate separate from the practice. You do not want the real estate owned by the entity that owns the practice generally. In tax matters, when you're buying the practice, you do need to come up with an asset allocation. You need to divide the price of the practice between dental supplies, equipment that you're buying, the goodwill, and the non-compete. The seller wants as much as possible to goodwill. You want as much as possible as the buyer to dental supplies and furniture and equipment. This should never be a deal breaker if you're the buyer, because ultimately over 15 years, you're going to write off the full cost. The seller does pay higher taxes on certain categories. So the seller probably will negotiate less on this than you as the buyer. But as I said, you do not want this to be a deal breaker. And that's it. So thanks again for taking time out of your schedule. I went through the last stuff very quickly, the last bit of information, but I hope I spent enough time on what I feel is the most important part of the due diligence of when somebody's buying a dental practice, and that is on the practice productivity. That's what you're buying. That's where you're going to find the opportunities, and that's also where you're going to find some potential pitfalls as well. So thanks again. I hope you found this helpful. Schwartz Accountants is our website. my email address, which isn't on here, is andrew@schwartzaccountants.com. And if you have any questions about practices that you've seen, if you want to help with the due diligence, anything like that, please email me right away, and I'll get back to you as soon as possible. So thanks so much. Bye.